All right. We're going to go ahead and take a look at some financial statements. I'm going to show you how to read the financial statements. We're going to be taking a look at Google here. We're going to start with the key ratios so that way you get a brief overview of what we're going to be looking at. We take a look at the revenue here, which is the total cash generated by the business. Then you've got your gross margins, how much it's spent to, they've actually only kept about half of that. And then, you've got your operating income here. It tells you basically how much they were able to keep of all this stuff here. The margins are a little bit difficult to understand. We're gonna get into it on the financial statements. So you got your margins and you got your net income here. So at the end of the day, how much do they actually cash in? And this is how much you get per share. So if you divide the number of shares, and this is their net income after all their expenses and whatnot, and then you divide that, you get the number of shares, you get the earnings per share. Cool, simple. Everything so far is pretty simple. The book value per share is a little bit different. This is kind of like net worth, how much the company actually has in net worth divided by the number of shares. So then when you're buying a share, you're actually only buying $300 of net worth from the company. So it's kind of interesting how that works. You're getting this much earnings per share, but this is how much net worth you're actually buying when you buy a share of Google. This is how much equity you're buying in the company. So the operating cash flow is basically going to be after they have their operating income here, which is generated by the business itself, they have other ways to make money, like investments and all that other stuff and things like that. So that pops up here in their operating cash flow. Then what you need to do is do CapEx spending. You're going to be spending a certain amount of cash to sort of run the business with CapEx, all the stuff you got to maintenance costs every single year. You have to spend certain amounts to run the business. It's going to be CapEx. And then you've got whatever is left. So you take your operating cash flow minus the CapEx, and now you're left with the free cash flow. This is what you have left over after every single thing has been spent, every possible thing you could spend. Now you have free cash flow left to invest further into the business if you want to expand operations. It's very important that you select companies that have free cash flow, because if you don't have cash flow in your business, you're not making money. So businesses need positive cash flow, because think about it. You've got your operating income, which comes from the business generating income, and then you've got the cap spending, which is how much it costs to run the business. So now you're left over with the cash flow. All right, so of course you get the cash flow per share, which could be divided by the number of shares and whatnot. And then you've got the working capital, which is the amount of money in the bank that they have access to right now. You can see they're growing their bank account pretty rapidly, and they got a lot of cash flow. So it's a really, really good company here. You could take a look at the profitability ratios here. You could see sort of some of these margins. The margins are pretty interesting to be looking at. The margins tell you how much how much they're keeping at the end of the day. And then you've got return on assets, which is really important. This tells you how profitable is the asset, how Google has a certain amount of net worth and assets and stuff like that. So they have certain amounts of assets. They own a certain amount of stuff, and that needs to generate income, needs to generate return on assets. So the better the return on assets, the better the property is that you're buying. All right, so Google has a return on assets about 10 to 15% a year, which is pretty dang good. You could think of return on assets as being like, say, if you had a house that you paid $100,000 for, it doesn't matter whether you're still in debt of the house or whatever. The house is worth $100,000. That's the asset. How much is the house worth? $100,000. So how much are you making per year if you have 10 to 15%? That's about $10,000 to $15,000 a year for a $100,000 house. That's how much it's worth. Now your return on equity is how much equity do you actually own of the house. So let's say you actually only own maybe $25,000 of it, or $50,000. About half of it's debt and half of it is yours. Well, half of it's 50,000. That's your equity. So what's your return on equity? What's your return on how much equity you actually have? So generally the return on equity is going to be bigger, because the return on assets is the total number and the return on equity is the number that you actually own, the net worth that you actually own. So we're going to take a look more at the assets minus liabilities in another thing. So none of this other stuff really matters too much. You can take a look at the growth numbers here. If you see lots of positive growth in the company here, then that's really good, right? Okay, lots of positive growth, lots of positive growth. All right, if you see lots of negative numbers, you know the company is basically just getting owned every year. So now let's go ahead and take a look at the actual financial statements. It's going to be a lot clearer, a lot quicker, easy peasy. Here, revenue. This tells you how much they actually generated. Then cost of revenue. How much did it cost for them to actually earn that money? So now you've got this. That's the gross profit, right? Then you've got research and development. You've got sort of all the random stuff that the CEOs might be buying. Just a whole bunch of nonsense, right? Research and development, they say. And then you've got how much are the CEOs compensated? How much are they taking in terms of pay? Their salary. So then you're left over with the operating income, which is left over from, how much it costs and how much the CEOs took out, and you're left over with some of this income left. And then you've got the taxes, and then you've got net income, which is available to you. So now you're the shareholder, you divide the net income, but it's all the shares, and you get the earnings per share. Okay, and that's how you take a look at the income statement. It's really easy. You just see what's their revenue, what was their cost of revenue, right? What's their profit? And then how much did they take out? Be very careful about this, because greedy CEOs will take a lot of stuff here. They're going to take a big chunk of their profit, and they're not going to leave that much for the stockholders. So you want to make sure that the CEOs take a small cut. Generally 30% is pretty reasonable. All right, so make sure to take a small cut, and you're left over with a lot of operating income, so that way you get more money as a shareholder. Okay, so just kind of take a look, make sure that you have high profit margins for gross profit, and high profit margins for the operating margin, and high net profit margins. When you have high margins, the company's making good money. If you have low margins, you're not making a lot of money. All right, you look at the balance sheet now, you can see how much cash they actually have in the bank here, how much they can use to short term. And then you have like all sorts of inventory and stuff like that they own, all the stuff in their inventory. So they have a bunch of assets right now, right? And then they've got stuff that they own, like buildings and things, and other intangible things like trademarks, equity, goodwill, all this other stuff. So they have all these assets, they have all this stuff that they own that's theirs. Now maybe they still have debt on that, right? Remember the house, so they own a house that is worth $123 million, right? $23 billion, sorry, $123 billion house, right? And so their return on assets on 123 billion was what, 10 to 15%, right? That's pretty good. Okay, but then after your total assets, you want to subtract all the liabilities. It's going to be all your debts, all your short-term debts, all the stuff that you owe to people, all the long-term debts. Look at the long-term debts, and then you have the total liabilities, which is right here. So total assets minus total liabilities, what you own minus what you owe, is going to be your stockholders' equity right here. That's your net worth. That's how much cash you're worth at the end of the day. You own this, but you owe this, so now you only have this after you pay that off. So this is your equity. This is your net worth. So when you buy a share, you're buying some equity in the company. You're buying a slice of their net worth. Remember that their net worth was, remember this gets divided by the number of shares, so you're only getting a very small slice of net worth. You're actually paying massive amounts for a very small piece of net worth, and that's kind of that's kind of the way it is. Now you want to make sure that the net worth is growing every year. So you can see here, net worth growing every year. You're getting more and more equity in the company. That means that they're treating their shareholders right? If you look over the key ratios one more time, you can see that the book value per share, this is kind of whether they're treating the stockholders right. Because the thing is, even if the company grows its net worth, if they add more shares, right, they keep adding shares, you're not going to be getting that net worth. Right, you're going to be slicing the pizza bigger. So even though the pizza is getting bigger, if you have more slices of pizza, you're ending up with a smaller slice anyway. So make sure that they're buying back shares, that the shares are actually decreasing here, and that the book value per share is increasing along with the actual net worth of the company, which you see over here. The book value per share, the number of shares, and the stockholder equity. When you have these things going up, stockholder equity going up, the book value per share going up, and the stock number of shares going down, then you're actually getting more and more equity as a stockholder over time. Then we'll take a look at the cash flow statement over here. This is really nice because you get to see all the stuff that they're doing with their income. So you got your net income and a couple of these other things that they're doing here to make a couple extra bucks. And then they're finally left over with the net cash provided by operating stuff. So remember, you've got sort of the net income from the business and then some other stuff that they're doing to generate some cash, which are kind of related to the business a little bit. And then here, now this is sort of all the money that's left, all the money that they generated. And what you need to do now is spend the money on CapEx, which is right here, which is this. Okay, this is how much it costs to sort of maintain the business, maintenance costs to maintain the business, so that you're left with free cash flow. And the free cash flow now can be spent here in these locations. And you can see that they've made some acquisitions, like they bought some like different trademarks and stuff. They made some investments, they matured some investments, and they did some other stuff. And make sure that these numbers are big negative numbers here, big positive numbers here, big negative numbers here, and big negative numbers here. When you see all big negative numbers, that means that they're using all the free cash flow to do other investing stuff. If they have a lot of free cash flow, but they're not spending it, then they're just putting it in the bank, and you're not really going to be, that's not really a good use of money, right? So you got to make acquisitions, you got to do investments, and then you have to pay. You might get some debt, so you can see they're taking on some debt, but make sure that they're paying off their debt and paying off more than what they're actually getting. So pay off more debt than they're getting, and then common stock issued. Make sure they're not giving out too much stock, but they're actually buying it back. Okay, make sure they keep buying back stock. More stocks that they buy back, that means you're going to end up with a more expensive share because now they have less shares, they have more equity, the shares are worth more, blah, blah, blah. There you go. So this is all just kind of the stuff that they're investing in here and here. This is the CapEx spending. This is the net income. So it's actually really easy to read these papers. Just look right here. Operating cash flow, capital expenditure, free cash flow, right? So it's super simple. Finally, there's one last type of little valuation here you can take a look at, which is basically sort of the averages of, I would say just the one that's most important here is price to book, in my opinion. So remember, so you're getting a certain slice of equity in the company, and the slice of equity is the price per book. So when you're paying, when you're getting a $300 equity in Google, they're giving you $300 with equity, right? Remember, the book value was $300. Well, you're paying actually 5.4 times that much. So you're actually paying like $1,600 to get $300 worth of equity. So you're paying 5 times the price to get that. But keep in mind that the book value and the price to book ratio here is a little bit iffy, because a lot of so if the asset is really good, it's gonna be priced higher. So this average number is gonna be higher. You want to kind of look at the average of the price to book is 4.4. So the average price to book is about 4.4. They're selling at a 5.4, so they're a little bit more expensive than usual right now. So you kind of want to look at the average book value and try to get into the company that you're purchasing when it's below the average book value. In fact, the lower that you can get the price to book number, the cheaper the shares are. If it's lower than 1, you're actually getting a really good deal on the share, because you're basically getting free equity. They're giving you extra equity. You're paying $200, but you're getting $300 of equity. Now, most companies that are really good are not going to be trading under book value, so just keep that in mind. But it's kind of a way to just judge whether you're getting a good deal or not on the stock. So that's basically sort of the end thing there. And it's brief overview again, like the most important things you want to look at are the revenue. The revenue right here is really important. Take a look at the earnings per share is pretty important. Take a look at the book value per share. That's also really important. Take a look at the free cash flow. Make sure that they have positive cash flow. And make sure that the return on assets are really high and the return on equity is pretty good as well. When you've done that, it's pretty good. Make sure growth numbers are okay. It doesn't matter too much. You look at the financials here and you're going to make sure that the balance sheet is good. You look here, how much equity, how much net worth is the company growing in, right there. And then that's about it. You can take a look at the cash flow. Make sure, again, take a look at the operating cash flow and the CapEx expenditure and figure out how much cash flow are they generating. That's important there. Take a look at the valuation. Look at the average of the PB ratio. Take a look at how much they're trading for now. You can see Google is slightly more expensive than usual, but hey, stocks are always supposed to be slightly more expensive. And that's always when it's the best time to buy. So that's how it works. Now you know how to read financial statements. Good luck.